more challenges for global markets as central banks keep lifting interest rates, and for Australia, similar risks but with labour markets still as strong as ever. Our outlook for the markets and the domestic economy on the first day of spring. The task for central banks to deal with inflation remains immense, despite some easing in supply disruptions and slightly lower energy and commodity prices. The latest speech from Federal Reserve Chair Jerome Powell reinforced the message that the most effective way to deal with an inflation shock is to push up interest rates to discourage spending and slow the economy down, and to keep rates restrictive until the job is done. As a result, US official rates are already up to 2.5%. and likely to nudge 4%, whereas here, our path to a more neutral policy will likely see a cash rate just below 3% by year end, and then probably settling in the low threes next year. The impact of these rate hikes, on top of the large increases in the cost of almost all goods and services, will be seen with a much slower growth rate next year. But the impact on the jobs market is harder to anticipate, given its unique position. Not only have we got the lowest unemployment rate since the early 70s at 3.4%, but for the first time on record, we have more job vacancies than people looking for work, which brings this week's Jobs and Skills Summit sharply into focus. The low unemployment rate is indicative of strong demand for labour, coinciding with the fall in net migration, international student numbers, and delays in working visas. So the short-term focus is clearly on these factors. But the medium-term imperative from the summit is to lift productivity to sustainably build wages growth above the inflation rate. Productivity growth has been relatively slow since the GFC, and as the chart shows, wages growth had halved over the decade from around 4% to only 2%, although inflation was even lower going into the pandemic. But since last year, the surge in inflation has overtaken the wage price index. This is one example of just how destructive inflation can be. It undermines wages and income, asset values, and purchasing power. So, if left unchecked, is a lot more damaging than any short-term economic downturn. The aim is to get inflation down to around 2.5% and also to achieve wages growth sustainably above that rate. Investment in human capital and leveraging new technologies will be crucial in achieving these outcomes. Despite inflated costs and RBA rate hikes, consumers are still spending more than ever based on the latest retail sales numbers, which is another unique attribute of our economy. While consumer sentiment is back down near GFC lows, retail sales are up over 16% on a year ago and around 25% above pre-pandemic levels. Good news for businesses and indicative of the strength of labour markets and household balance sheets, but a reminder that RBA cash rates will need to be maintained at a higher level and for longer to slow down this demand. As a result, in line with last month's update, any thoughts of an easing cycle next year appear premature. So we continue to forecast lower GDP growth in 2023, around 1.5%, a slightly higher unemployment rate, hopefully only back to the fours, and after the 1.6% fall in property values in August, a peak to trough record fall for property in the mid-teens, but in the context of the significant recent gains. And lastly, the Australian dollar is still struggling against the relentlessly strong US dollar. It's actually been a solid year of gains for the Aussie on a trade-weighted basis and on the cross rates, but the geopolitical backdrop, the headwinds for the Chinese property sector, and the strong greenback are key factors for the next few months. And that's the market update from Leveraged.